Welcome back to Investing Talk Podcast.
Today we're looking at American Resources Corp.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so American Resources. You really have to understand that this is a company in the middle of a huge strategic pivot.
A massive one. I mean, the company they were 18 months ago, it's not the company they are today.
Not at all. They're moving away from their old operations, and the entire story now, really everything, it rests on their subsidiary.
ReElement Technologies.
Exactly. That's their play on domestic rare earth elements, the whole critical mineral refining space.
And, when we look at the numbers, that pivot is, it's pretty brutal.
It's screaming at you from the page. I mean, look at the top line. The fiscal 2024 revenue was tiny, something like $383,000.
And compare that to the year before, they did almost $12 million.
It's a cliff, a complete cliff. That kind of drop immediately tells you this is a super high-risk execution story.
It's absolutely severe. And that lack of revenue means all the financial weight from the past is pressing down on this really promising future.
Which is why we have to start there with the financials.
Yeah.
Because it puts everything else in context.
For sure. So the balance sheet.
It's just incredibly strained. The first thing you look at for liquidity is the current ratio.
Right. And theirs is 0.1.
0.1. Let's just pause on that. For anyone listening who doesn't stare at these all day, a healthy ratio is 1.0. Maybe a bit more.
Yeah, 1-to-1 assets and liabilities.
0.1 means they have 10 times more short-term debt than they have cash or assets to cover it. They are truly running on fumes.
It signals extreme urgency, and it doesn't stop there.
No. Then you've got the stockholders' deficit.
Which is basically negative book equity. As of Q3 2025, that's sitting at what, $93 million?
$93.4 million. They owe significantly more than they own.
And this is why, if you dig into their reports, you see that going concern language over and over, which is basically the company's accountant saying, look, we have serious doubts they can continue operating.
And they keep losing money, a $6.3 million net loss in the third quarter alone.
So, here's the fundamental tension for an investor, right?
Yeah.
How can a company in this financial state with a 0.1 ratio and $93 million in negative equity possibly fund the massive growth needed for a domestic rare earth supply chain?
It seems like it can't be done mathematically.
And that brings us to the but. The only reason we're even talking about this.
Right. There are mitigating factors.
Big ones. The first is outside cash, and the second is a really unique technology.
So they tackled that liquidity crisis back in October.
They did. They closed a $33 million PIPE financing.
A PIPE, private investment in public equity. So they sold shares directly to bigger investors.
Exactly. And $33 million, that's a major lifeline.
Is it a solution, though? Or just a Band-Aid when you've got a $93 million hole?
It's the raft. It's not the rescue ship. It doesn't fix the deficit overnight, but it gives them the cash to finish their projects and prove the model works.
And the fact that big investors were willing to put in $33 million, even with that balance sheet.
It tells you they believe in the second part of the equation.
The competitive moat, the technology.
ReElement's proprietary process. This is where it gets really interesting.
Because rare earth elements, they're in everything. EVs, defense tech.
F-35s and magnets, everything. And most of the refining is done overseas. ReElement wants to change that here.
And their key isn't just digging it up, it's the purification process.
That's the whole game. Finding rare earth ore isn't the hardest part. It's separating the 15 different elements from each other cleanly.
Which is usually a pretty dirty and expensive process.
Extremely. Uses tons of toxic chemicals, energy, water. ReElement says their process is cleaner, cheaper, and gets them to like 99.999% purity.
And that level of purity is absolutely essential for defense applications, for high-performance magnets.
Non-negotiable. So if that's true, their advantage isn't what they mine, it's how they refine. They're a tech company, not just a miner.
Which aligns perfectly with U.S. government policy, this whole push to onshore critical supply chains.
Exactly. They are riding a massive macro tailwind.
And it's already paying off. We're talking huge government partnerships.
The November announcement was a game changer, being named a participant in that $1.4 billion U.S. defense partnership.
$1.4 billion. That's focused entirely on scaling up domestic rare earth magnet production.
It's a stamp of approval from the Pentagon. It's a massive de-risking event for them, even if we don't know the final contract value yet.
And that's not the only one, right?
No, they're also a finalist in that NSF Regional Innovation Engines program.
Which could mean grant money, up to $160 million over 10 years.
And that's non-dilutive capital. That's free money that doesn't hurt the balance sheet. It would completely change their financial story if they land it.
So you have this split narrative. Terrible financials from the past, but this incredible tech-driven, government-backed future.
So what does Wall Street think it's all worth?
Well, the outlook is it's just explosive. Analysts are extremely bullish.
Which you have to be, I guess, if you just ignore the balance sheet for a minute.
Right. They're projecting just eye-watering growth. The average forecast is for, 179% revenue growth in 2025?
And the high end of that range.
Goes up to 722%.
700% growth in 1 year.
Okay.
I mean, in this sector, that's a staggering number. It assumes flawless execution.
It's the absolute best case scenario, that everything comes online perfectly, the contracts hit, it sets an incredibly high bar. Any delay and the stock could get punished.
And yet the market seems to be buying it. The analyst targets are all pointing to significant upside from here.
Yeah, something like 40 to 60% with price targets around $5.50.
So the market is pricing it like a national security tech stock and just forgetting about the legacy business completely.
The stock chart basically confirms that. It's been incredibly volatile. The 52-week range is something like 38 cents to over $7.
Wow. That tells you it's a pure speculation vehicle right now.
It is, but it's in a clear uptrend. It's trading way above its 200-day moving average, which is down around $1.65.
So investors are buying into the news story.
They are, and it looks like it's found a solid floor of support around that $3 level.
But we should talk about the mixed signals on the ownership side.
Right, because on one hand, you have those institutional funds that put in the $33 million for the PIPE. That's a huge vote of confidence.
For sure. But on the other hand, you have to look at what the insiders are doing.
The open market sales.
Yeah. In early November, a few insiders, including a key executive, sold a pretty significant number of shares.
Over 300,000 shares combined.
That's a lot. And while management might say it's for personal reasons, in this context with the going concern risk, it raises questions.
It's the constant tug-of-war, isn't it? Long-term confidence from new money versus the immediate reality for the people on the inside.
Yeah. So let's look ahead. The next 3 months are just packed with catalysts that could prove this whole thing one way or the other.
Okay, first up has to be earnings. Q4 2025, coming out in mid-January or February.
That's the moment of truth. They have to show that the money they raised is turning into actual commercial revenue. Even if it's small, it has to be growing.
And beyond earnings, we need to see operational milestones.
Specifically, news on the Noblesville expansion project.
This is the big one. It's supposed to increase their refinery capacity by 141%.
You don't get to 700% growth without that facility running smoothly and soon.
Then on the market side, there's the ETF rebalancing on December 4th.
Right. If they get added to some of those clean energy or national security ETFs, that can drive a lot of volume just from passive funds buying in.
Now, what about the more speculative stuff, the rumors?
The loudest chatter is about them landing a big direct defense supply contract in 2026. They're in the partnership, but a direct contract would be the real prize.
That would solve their cash flow issues almost overnight.
Completely. There's also some talk about joint ventures in Central Asia, maybe Uzbekistan, to broaden their access to raw materials.
And then there's the dark cloud that never really goes away.
The Nasdaq compliance review.
With the negative equity and all the past issues, there's always a risk there. If they were to get a delisting notice, it would crush institutional interest.
It's a risk that's directly tied to their ability to ramp up revenue now.
So, to try and summarize this for everyone, it's an incredibly complex picture. You have this high-tech domestic leader story.
Right. A pure play on the U.S. reshoring trend with huge government support. That's the bull case. It promises massive returns if it works.
But all of that potential is trapped inside a company with a really, really stressed financial structure.
Severe pressure. The negative equity, the balance sheet. It's all still there. The whole thing hinges on execution. They have to make the leap from a company with a good story to a company with good revenue.
And that inflection point is coming in the next 6 months. You're really just betting that the tech and the political momentum can outrun the financial reality.
If they get that Noblesville facility running and land one big contract, the balance sheet problems become a footnote to the story. If they stumble, that financial risk becomes the whole story.